Our next guest believes the tech wreck is far from over. Tom Lee is head of research at Fundstrat Global Advisors and a CNBC contributor. Tom, always good to see you. You have said the tech trade is done. Is that what, in fact, we are witnessing right now?
Yeah, I think tech's leadership, which was so astounding for the past decade, I think we're seeing a new leadership emerge. And I think that's one of the things that is sort of central to our thinking is what is the market telling us? And the leadership of energy and the financials and cyclicals to us is really telling us a vigorous economic recovery is underway. These cyclicals could turn into growth stocks, which means traditional growth stocks aren't as shiny and as interesting.
Does that necessarily mean, I mean, Tom, if you believe in all of these sort of growthy, cyclical, not growthy, but leverage to the growth story, I should say, names are going to go higher, and that's where the leadership is. Does that necessarily mean that inflation will, in fact, go higher as well, and so will bond yields?
Well, I think we're struggling with what that means, and I think the market is, because inflation has essentially been eradicated from the market's thinking for the last 12 years. And I think that's why there's this hypersensitivity to both rates and inflation expectations. But, I think the Fed's been pretty clear. If energy rises or commodity prices surge and it causes CPI to rise, that's not really inflation. It'll show up in CPI. But what they're worried about really is a change in how people's inflation expectations are anchored. I think that's going to take quite a lot of time. So I think you have a period where the economy could run really hot. That's why the cyclicals are rallying. But it's not something that's going to force the Fed's hand. And I know the bond market's been testing the Fed, but that's really the question. I mean, it's a key question.
So, Tom, I'm in your camp. I've been playing the value trade as well. Are you playing? What I've been doing is playing European levered value plays, especially in the chemical space. Europe has lagged, and they have a bigger leverage towards a reopening trade because they're based more on tourism than we are. Are you thinking about that dynamic?
I mean, Europe's interesting because it has lagged. We did a little global sort of look around for our clients yesterday, and the leadership for equities has come out of China, Korea, and Japan. Those have really led the turn. And then we're starting to see like Chile and then U.S. cyclicals sort of start to participate. So to me, it feels like domestic cyclicals are really early in turning up, and they're not extended. But eventually, I agree. I think then it would lead to European financials starting to rally because they're the epicenter of the value trade within Europe.
Tom, it's Karen. Let me ask you something. If you think this rotation is really happening and tech is going to be sort of somewhat of an anchor on the market, do you think the market as a whole will rise?
Yeah, it's a dilemma. Tech and growth is 67% or 2/3 of the market cap, and it's really what builds careers for most institutional investors. So growth stocks are really what the professional money manager trades and understands. I think there's a chance that growth just does okay. Jeff DeGraff mentioned that because there's money flowing into the market. But for someone to have beat the market, outperform, it's really that 23% or 30% cyclical exposure that's going to do it. And of course, energy is an example. Energy's up 30% this year. I would say out of our entire client base, maybe 5% have dabbled in energy. Most have actually essentially zero weight in the energy sector. Most think it's just an annoying little group that's risen.
Tom, it's interesting that consensus is now that the economy is going to come roaring back. And so, I want to go to the contrarian thinking on this, and that would be so many states are lifting their restrictions now. And while President Biden moved up the timeline on getting U.S. adults vaccinated to the end of May, there's still that critical time period, and the variants are still out there. Is that a possible sort of caveat to this whole forecast of yours?
Yeah, I mean, COVID's unpredictable. It's super dangerous. The variants are out there. So nobody can say COVID's been vanquished. But if you look at a state like Florida, that's been open, really relatively open for a while, their economy has actually been quite booming. And then if you look at states like North Dakota and South Dakota, where the prevalence of COVID plus the amount of vaccinations is over 60%, they've seen a 95% drop in cases I mean, South Dakota now has like less than 100 per day. And so those economies, as they open, also have what appears to be a lot less risk. So I might say that the contrarian view would be people aren't bullish enough about the reopening, because this is really like a post-war reconstruction period with government stimulus. That is extremely boomy for real investment spending, which is the biggest multiplier to GDP.
Wow. Tom, always great to get your thoughts. Thank you.
Yeah, thanks.
Tom Lee of Fundstrat. Wow, people might not be bullish enough, Grasso, which says to me inflation, inflation, inflation. I don't know about you.
It does. And if you look at, we talked about spending, we're on the first relief bill of the Biden administration. And we're talking about, I've thrown that number out there, of $10 trillion in spending coming. We haven't even spoken about infrastructure that'll be probably coming in the middle of the summer. You're looking at GDP probably of 6 to 7%. All the street is focused on is about 4%. They've underestimated that. Inflation is coming, and that's why you want to buy value.
Shepard Smith here. Thanks for watching CNBC on YouTube.